All right, so we'll start the call off with the basic stuff, guys. So we're gonna go ahead and talk about candlesticks. So black candlesticks, my prima Mayra. Welcome, Mayra. Welcome, prima. Welcome. So these are called candlesticks, right? Like you guys look at the sticks, they're called candlesticks, and that line that you see sticking out of it is called a wick, right? So those are wicks. So white candlesticks means the market's going up. Black candlesticks means the market's going down. And some people change the colors, right? You could change the colors to whatever you want. You're welcome, Mayra. You're welcome. You could change the color to whatever you want. You could put it green, blue, purple, whatever you prefer. Personally, I suggest you guys to do just black and white because if you guys know, colors are emotions. You know, it's an emotion. When you see a color, it produces emotions. That's the reason they make all the like the fast food restaurants. They're always red and yellow. You know, they're bright colors. You know, because that makes people hungry. You know, it's marketing tactics. So colors produce emotion. The reason my mentors taught me to put black and white is because it's not going to create like emotions in your brain. It's just simple. The most simple you keep it, the better, you know? That's the way I was taught how to trade. Keep it simple, right? So candlesticks, you know, now we got different time frames. We got the monthly time frame. What does that mean? Like one candlestick in the month is 1 month of time. In the weekly, one candlestick is 1 week of time, right? In the daily, one candlestick is 1 day of time. In the 4 hour, one candlestick is 4 hours of time. In the 1 hour, one candlestick is 1 hour of time. And so on, 30 minutes, 15 minutes, 5 minutes, 1 minute. Okay. You could, in the 1 minute, there's actually some, like if you go to trading view, you could go into seconds, but you got to pay for that. You could go like into like, you could see it in the 1 second, in the 10 second, in different time frames, but that's the premium on trading view, right? So far we good? Everybody understood the time frames and candlesticks? Yeah. Let me get some, yeah, perfect. All right, cool. All right, if you guys got any questions, please ask me, stop me before I continue, right? So now that we know candlesticks, let's talk about risk to reward, right? Like let's talk about like how we gonna put a trade in. If you want to stay in this business, leave hope at the door and put a stop loss. That's true. That's true. Stop loss is super key. So basically, I'd tell you guys what we're gonna talk about risk management real quick because that's something really important. Like before you even put in a trade, you should know how much you're risking, right? So we're gonna talk about risk management. Risk management. So when I'm referring to risk management, it's simple, guys. I'll keep it simple for you. So let's say, since we're all working on getting funded, right? We're all working on getting funded. We're gonna apply everything towards the funding challenge, right? How we gonna once we're funded, how we gonna maintain the funding? You know, that's super important. How you gonna maintain the funding? By using proper risk management. What does proper risk management mean? Proper risk management. Management. I forgot how to spell management. Whatever. Management. I think I'm missing that either somewhere. Whatever. You guys know what I mean. So let's say we have a 10K account, right? A 10K, $10,000 account. Like that's the smallest account you could have in my Forex funds, right? So let's say you have a $10,000 account, right? So what does that mean? So a $10,000 account, you should be using proper risk management. You should be risking per trade like 0.5%, right? 0.5%. So we go, what's a 0.5%? So 0.5%. That's how much you want to risk per trade. Max, right? Like you don't want to risk too much. Even if you could risk less than this, will be preferably better, right? So $10,000 at 0.5%. John is doing a call right now. So that will be $50. That's going to be your risk in this trade. You're going to be risking $50. $50. $50. Right? So $10,000, half a percent will be $50 per trade, right? So how you gonna determine what your risk is, right? Like let's say you have a 20 pip stop loss, right? 20 pip stop loss, 20 pip stop loss, which is the average, right? Sometimes we do 10 pip stop loss, but let's start with a 20. So a 20 pip stop loss, right? What does that mean? Like let's say you're going over here and you're gonna calculate 20 pips, right? So let's go to a smaller time. Oh, never mind. So you're gonna calculate like 20 pips from the entry, right? 20 pips, which is like somewhere here. Yeah, go ahead. Any questions? Welcome to the call. Whoever just hopped on, welcome, welcome. We're practically just talking about candlesticks and risk management. Okay, keep it just basics. So 20 pip stop loss. How you gonna determine your 20 pip stop loss? It's gonna be simple. All you have to do is divide 50 divided by 20, which equals like 2.5, right? So that's going to be how much you're going to put in the trade. 2.5. That's going to be the amount of dollars per pip, right? That you're going to be risking, right? So basically, when you're looking in the MetaTrader 4, let's talk about this. What does a 2.5 look like? So in the MetaTrader 4, they give you like something like this, right? Like a 0.01, which equals 10 cents, right? When you put the trade, a 0.01 is 10 cents. So far, so good. You guys got any questions?
Oh,
All right, cool. So a 1.0 equals $1 per trade, like $1 per pip, right? Per pip. Say 0.1 equals $1. $1. This is like super basic stuff, but it's important for you guys to understand this, right? Right here we got also a 1.0, which equals $10 per pip, right? $10 per pip. So if I was to ask you, how you gonna put $2.50? We're going $2.50 will be what? You guys know the answer? So basically $2.50 is a 0.25. That's how much you're gonna put per trade in this order, right? That's how much you're gonna put. So you guys understand this so far? Like the division, how to put the trade in, like it was a 20 pip stop loss. This is how much you're gonna put in that order. You're gonna put a 0.25. We're good? Yeah, let's see. If you want to stay in this business, you don't need to trade 5 days a week, trade 4 days a week, so you will be smarter doing the trading. Hey, Mike, do you prefer trading from a phone or a computer? Personally, I use both. I like the computer better because it gives me a better perspective, but the phone is cool too because in the phone you could like they both correlate with each other, you know? You mark up in the computer, then you know what your bias is for the week, so they both correlate.
yes.
All right, so everybody understood this part. Should we do one more example? Let's do one more example. So let's say we have a 10 pip stop loss, right? 10 pip stop loss, right? 10 pip stop loss. So we're gonna go ahead and divide. Now we know how much you're gonna risk, right? You're gonna risk 0.5%, which is $50 on the 10K. So we're gonna go ahead and divide 50 by 10, right? Hey Google, what's 50 divided by 10? That's like $5. Yeah, $5. So that will equal $5. So 50 divided by 10 equals $10 per pip. Does that make sense? No, $5 per pip. $5 per pip, my bad. $5 per pip. So $5 per pip in this trade, which means you're gonna put a 0.5. This is super important, guys. The reason I'm emphasizing this and I'm starting the call with this is because if you guys really stick to this, you're gonna save your account from blowing so many times, guys. Do not over leverage, guys. This is like the most important thing that I'm teaching you right here, like how to put the trade and have proper risk management. You know, because what happens if you start over leveraging, right? Then instead of taking a $50 loss, you're gonna take $100, $200, $300 loss, and that's not good, guys. You guys gotta protect the account. Protect the account. And how you gonna protect the account? By risking accordingly. And sometimes you might over leverage, right? You might over leverage and you might get lucky, right? Boom, and you catch a nice trade. Then you gonna over leverage again, and then you catch a nice trade, and then you're gonna catch another trade. You keep over leveraging, but that's just something like bad's gonna happen. You know, eventually you're gonna hit that. You're gonna take that L, and you're gonna lose 300 bucks. You're gonna lose 300 bucks, 500 bucks, and then you're gonna go into a revenge trading pattern. You know, you're going a downward spiral. You know, because now that you're down 500, you're gonna try to over leverage even more, try to make up the 500 that you lost. So now you lost another 500. Now you're down 1,000, right? And you blew your account. Because basically, in my Forex funds, if you lose more than 5%, you lose the account. So you guys know there's rules for, let's just look at the rules. We should look into that. I always tell my traders not to over leverage. The reason I speak this, guys, is because personally, I used to over leverage a lot. I blew a lot of accounts. And it sucks blowing accounts, guys. I don't want you guys to blow accounts, especially now that we're about to get funded, right? We're about to get funded 100, 200, $300,000. The key is just to protect the bag, guys. Protect the bag. How you gonna protect the bag? By doing proper risk management. So if you guys see a trade, do the math every time. Like, okay, I want to risk. If you guys want to over leverage, the max you could risk is 1%. And I still think that's too much, right? Because you should be able to like take 5 losses in a row, and then you get that one trade that freaking brings you back into profit. You feel me? So it's super important, guys, to use proper risk management. Everybody understand risk management? Yeah. Yes, thank you. Sure, for sure, Angel. So all right, next, what you guys would like to, I could talk to you about the strategy that we use. You know, I could point out some mentors, some videos you could watch on your own. You know, like I could put you on game, guys. So okay, so proper risk management, candlesticks. What else should I cover, guys? Besides, before I move on, anything else you guys want me to cover?
Hey Mike, yeah. How do you use the Fibonacci? I think that's how you call it, right?
The fibs. You want to learn the fibs? I got you.
Yes, please.
I got
I
you.
forgot about it. I used to do it, but I forgot. It's been so long.
I got you. All right, so let's share my KOT. I got the fib set up on that one. KOT Forex. Yeah, the fibs are important because being safe about the 10K is easy, no sweat. Yeah, just keep it safe, guys. Keep it safe. All right, so let's talk about the fibs. No connection? What you mean no connection? whatever. We just use a present example, doesn't matter. Okay, so let's look at this range, right? So basically, the fibs are really important. Why are the fibs important? Because the fibs is a tool of measuring the retracement, right? The fibs. So you guys know, I want to show you guys a quick video about fibs. The Fibonacci sequence is all over the universe. It's in nature. It's in anatomy. It's in space. It's basically the math of the universe. You know, it's like the creator. The creator created everything perfectly, and everything is aligned with the Fibonacci sequence, right? So let's look at it. Fibonacci in nature. The Fibonacci repeats itself in constantly all over the universe. Anatomy, like I said, animals, plants, fruits.
Bro, when you first join in, it says teleport. Click on that.
What a job that I don't hate.
Facts. That boy said I want to shut that. Hey, okay. All right, so this is the Fibonacci, guys, in nature.
So good. How did you not know there's a practice area?
Numbers 1, 1, 2, 3, 5, 8, 13, 21, 34, and continues indefinitely. Each number is obtained by adding the last two digits together. If we were to take a perfect or golden rectangle, break it down into smaller squares based on Fibonacci's sequence, and divide each with an arc, the patterns begin to take shape. We begin to see Fibonacci's spiral. The spiral in and of itself is insignificant. Its importance is revealed in where we find it. Take, for example, the sunflower. The display of its florets are in perfect spirals of 55, 34, and 21. The sequence of Fibonacci. The fruitlets of the pineapple create the same spiral based on the sequence. The pine cone does the same. As currents move through the ocean and the tide rolls onto the shore, the waves that bring in the tide curve into a spiral that can be mathematically diagrammed onto a plot at the points 1, 1, 2, 3, 5, 8, 13, 21, 34, and 55. Buds on trees, sand dollars, starfish, petals on flowers, and especially the nautilus shell are formed with this exact same blueprint. With each segment of growth, the nautilus adds to itself one more value on Fibonacci's scale. This blueprint can be seen around us on a small scale every day, but the greatest example of all is directly above our heads. At an average of 100,000 light years across, even the spiral of the galaxies above us are formed with the exact design that the tiny shell is formed. This sequence or blueprint appears to be the trademark of a designer.
That's cool. You guys could always go into YouTube and do more research about that. I just wanted you guys to show you a little bit about it. So Fibonacci, basically, the way you're going to use the tool, you're going to always, like if, for example, this range, right? You're going to measure the range from the highest high to the lowest low, right there. And we use a special fib too. We use ICT's Fibonacci, right? So we have a key area of interest in his fibs, which is the OTE entry G spot and the OTE, right? So this area right here, that what the market likes to do, the market likes to, once I have that area measured, I know that the market might want to come over here and it's going to sell, right? And like, let's back test that. Let's back test that theory. So you guys don't think I'm just talking out my ass, you know? So basically, let's look at it. Let's look at previous ranges. Let's look at a previous range. So for example, we're in the 4 hour, okay. Let's see. Okay, right here. So look at this. So from this low to this high, right? It came down to the OT right there, and it shoot up, right? So that's one example. Like it comes, it touches it, shoots up. Then actually here, this is something else. This is called a turtle soup. So you see how he took that low? He took that low out. So the banks, they like to be greedy. They're greedy. So anybody that got into a buy here, they came back, they took them out the game, you know, they took all those buyers here, they took them all out. They came back out, and this would have been a really good entry right here. But that's a sniper entry. That's like a turtle soup. But let's look in the daily something real quick. So if we were to put our fibs from this low to this high, right? Look where they end. Look what that wick ended. That wick ended really close to the OTE. It almost touched it, and it started shooting up. So that's another example right there. And look at this range right here. Also for sales. For sales, you go from the highest high to the lowest low. You put your zone right here, and look, the market came there, it came to that area, and it started shooting down, right? So those are areas of the reason of what you actually call this. I might explain it to you in another way too. So those are the key zones that I look for in my fibs, but also I want to explain to you guys something else about that the fibs are important, right? The fibs are really important because let's put a new chart. The fibs are important because you could actually see if the market is in a premium or in a discount. What does that mean? Premium and discount, right? So for example, you're gonna take out the 50%, the EQ, right? The EQ. So the rule is if this is your range, right? And if it goes above the 50%, all the way to the 100, this will be considered premium. The price is on a premium, right? So you're looking for sales. When the price is on premium, you're looking for sales. But if you were to do actually the whole range, like from here to here, then we go to the 50. So this will be actually a better, I like this better over here. So the premium should be over here. Hey, welcome to the call. Welcome to the call. So this is your premium from here to here. And this is your discount from here to here. So when the market is in a discount, you're gonna look for buys, right? The green zone, you're gonna look for buys. But you wanna hop in a buy, like down here in the bottom of the range. That's where you have the less risk. Why? Because your stop loss is gonna be here. Your stop loss is gonna be like below this wick, right? But if you were to like come over here, hop on this buy right here,
Yes.
that would have been a really good.
You said what? You said what?
That would have been a fire entry, right? Because you're only risking a little bit, right? You're risking a little bit. That's the reason why it's important when to buy and when to sell, because according to the fibs, you always want to buy or sell. You always want to buy or sell like around like the highs, around the highs and around the lows. So you want to sell at a premium, buy at a discount, right? So you wanna buy at a discount and sell at a premium. You guys understand that concept? Premium above the 50%, discount below the 50%. You guys understand that? Premium and discount? Let me know. Yeah, cool. All right. Any questions so far? No?
Mike, can you also explain, because my cousin, I was actually telling her about the stop loss.
Yeah.
Can you explain her about the stop loss too?
Sure, I got you. Stop loss. So we that goes back to our first lesson. about risk management, right? So let's go to this. So back to the stop loss, right? So you have a 10 pip stop loss. You have a 20 pip stop loss. What does that mean? What does that mean? So we're going to put a new chart, right? Oh, look over here. So let's say you want to go in for a buy at this area right here, right? Let's say you went for a buy. You buy right there. So now, let's say the red line is your entry, right? That's your entry. And the stop loss, we're going to measure it with the tool. We have a tool that measures the pips. So 10, 11, 20. So you're going to put your stop loss right below here. I could actually give you an example in my phone, and we could do like a trade in my demo account, just for so you guys could learn. Let's see, share screen, host, make host. Do you want to change hosts? Yes. All right, so let's share my screen on my phone. Start recording. All right. You guys could see my phone. So we're gonna go to a demo account. This one. All right, let's look at Bitcoin. I know we could trade Bitcoin today. The crypto market is always open in the weekends. All right, cool. So you also gotta understand that in crypto, the stop loss are totally different because a 20 pip stop loss in Bitcoin, you need more room than a 20 pip stop loss. All right, so right here, it looks like it's gonna go for sales. Yeah, let's go for a sale. So we're gonna go right here. So this side right here, that's where you're gonna put your stop loss, right? So how you gonna measure your stop loss? You go back to the chart, right? You go back to the chart. And they say your stop loss is gonna be, so if you're going for a sell right here, right? We want getting closer. Let's get closer. So I will put my stop loss if I was going to for a sell here, but it actually looks like it wants to. Let me see. Yeah, it looks like it wants to buy, but just for example purposes, we'll go for a sell. So we're gonna put a stop loss over here at 21,662. So we go back to the trade, and we put here 21. There's EU. And okay. There you go. 21,662. And your take profit, you could leave it open. You don't really need to put a take profit right away. Let's risk a lot, just for fun. Let's risk like 100 lots and see what happens. Wow. It was in drawdown right away, 50 Gs. That's crazy. And the reason it's in drawdown right away, guys, is because the brokers, that's how they make their money. That's how they make their money. You know, they're gonna like the what you guys see here, you see the spread, that's how they make their money. So we went for a sell here, but in reality, we're in a sell at 21,612. So in order for us to get in profit, the market has to drop all of this. And once it drops all of that, then it'll give us profit. But every time you start a trade, it's always going to be in a drawdown. Even if it's like, let's say like a smaller trade, right? Let's put another one. Look, this one is 300 negative of the RIT, right? So the spread in Bitcoin is pretty high right now. That's what that means. This is a big account, so I don't care. It's a demo account anyways. So it's getting us confirmations that he wants to go for a sale. You know, we have a wick over here. It's wick. Can you see those wicks? Wick, wick, Now we have some railroad tracks. Now we're getting an inverted hammer, like a shooting star, starting to drop, you see? So once it starts to drop, but regardless, the spread is so high, right? The spread is this line. So we gotta wait for this line to come all the way down here. And once it comes down there, we'll be in profit. So we'll just let it sit for a little bit. We'll wait it out. Meanwhile, that's how you put a stop loss. You just, when you put the trade, you put the stop loss here in this part. So you're going, whatever you stop loss is 21,800. And you want to put your you take profit, let's say 20,000, right? So then you could see your trade here. You could actually modify the trade from here. Let's say you don't like something, you could always change the stop loss to whatever you want. You know, you could play around with it. You know, you change the stop loss, you look at it, boom, boom, boom. And that's basically it. That's how you put a stop loss. Always do the math though. Make sure you know how much you're risking. Like what is the proper risk management, right? If we say we're gonna risk 50 bucks, risk 50 bucks, right? 100 bucks max, or whatever your account size is. If you have like a 50K, you know, you're gonna risk less. You know, like if you just control the risk management. Anyways, let's share my other screen. Stop shit. Let's get my other host back. So that's risk management. We talked about like the candlesticks. We talked about the fibs. Let's talk about fair value gaps. So what's a fair value gap? This is something that's really important, guys. In order for you guys to find points of interest, like when you were asking me, like, what are my points of interest, right? Like, where do I go for sales? Where do I go for buys? Personally, I like going for sales or buys. I like liquidation areas, right? Like, for example, here, you see this space. There's a space right here. You guys can see my screen? Yeah, right? So the space between this wick and this wick, that's a gap, right? So these are areas that the market haven't touched. Remember how I talked to you guys about remember how I talked to you guys about how the banks are greedy and they don't want to let nobody win. They're constantly liquidating, right? So what is liquidating? Liquidating, it means all this space right here, all this empty space, that's money in the table that the banks are leaving. They're not taking, right? So if anybody went for a sell over here, right? If you went for a sell here and you're eating, right? You're eating, you're like, okay, I'm eating, right? Now, if you didn't close your trade, right? If you didn't close your trade, you could see the banks, they like this area too. You know, they brought the market down there. So it was at a premium. Now it's at a discount. Remember how I talked to you about premium and discount? So the banks sold here, they're selling, right? Then they took it back to the price they like. So they like this area. They like this area right there. How you know they like this area? Because look, there was resistance here and there was resistance there. I mean support, sorry, support and support. That's a key area for the bank. So they bought at a discount. So they started buying. What they're gonna do now, most likely, they're gonna bring it all the way back up again, right? Take this gap out. So most likely you have like a reaction here. Have a reaction there. Then they'll bring it, there's possibility they'll bring it back down, right? They'll bring it back down to shoot it back up and take these buyers out. I mean, these sellers, whoever sold here, they're gonna take them out. And that's how all the pairs basically work. The more you watch the pairs, the more you understand how the banks are manipulating, because this is manipulation, guys. There's nothing fair about the market. It's pure manipulation. Those guys, they got hedge funds. They have millions of dollars. Like they could literally move the market. You know, me and you, we cannot move the market. Even if we have 100 people in our team, we cannot move the market. The amount of money those guys control is incredible. So all of this is manipulation. When you guys see like big candlesticks like this, that's manipulation. That's manipulation right there. You know, they're manipulating. They're taking the market to areas where they like. So they took it here and they sold. They dumped it. Boom. They dumped it. Boom. Right? Now that it's back at the area they like. So that would have been a perfect buy right here. So basically, what I'm trying to teach you guys is trade like the banks. Trade like the banks. Learn how they think. You gotta like think how they think. You know, it's like one of my mentors say all the time, Johnny. He's always talking about like you gotta play chess. You know, it's chess, not checkers, right? You gotta be 3 steps ahead of them. So you gotta know the areas of interest. So for example, here, look, there's a gap right there. There's a gap right there. And the gap got filled. It got filled. Like they took that gap out. They took it actually all the way down to this low, and now they're bringing it back up. So if you want to look for buys, you want to look for buys in the retracements. So you use your fibs. You put your fibs from low to high. Look where the market came. It came to our OT entry, our G spot OT. It came to that area. That would have been your sniper entry right here. That would have been a really nice sniper entry. You know, because you saw the market react, you were patient, it took these highs out, so there's a change of trend. You know, not that now you know it's changing trend because it took those highs out. It started taking out highs. It's taking out highs, taking out highs, taking out highs, taking out highs. So now we have a change of trend. Look at so it went from making lower low, lower low, lower low to making higher highs, higher highs. So most likely the next play, which is doing it right now, is right here. That's the next retracement. So this area right here. Sorry if my chart's getting messy, guys. So most likely right there, right? So look at it. The market came here. It's testing that area. And now it's shooting again. So that's how you stack positions, right? Now you know that it's going on an uptrend again. Boom, boom. So now where is it going to go next? Most likely it's going to take these highs out. It's going to take those highs out and keep liquidating. It's going to keep liquidating all of this space. All that empty space, they want to liquidate. They're greedy. They're not going to let nobody win. Remember that, guys. They're super greedy. So far, so good. How you guys like the class? See? Any questions? Love it? Okay, perfect. No problem. So yeah, that's basically it, guys. You guys got any questions? I went through basics. I don't want to like take too much of your time. I know you guys are busy, but we could do another call tomorrow if you guys like. We could do more calls throughout the week. I'm always available for these calls. Yeah, I'm here. Don't be shy. Ask me questions. Ask me questions before we stop the call, guys. If not, I think that's it for today. And we could do another one tomorrow. What you guys think? Yeah, tomorrow sounds good. All right, cool. So we'll do a call tomorrow, and we'll call it a day for tonight. Hope you guys learned something. I hope you guys took notes.